Hi folks, welcome back to the second part of our video, and in this case we're going to look at our statement of financial position, also known as balance sheet, and look at the final numbers in the equity section. We don't have any preferred shares in this question. You can go back to the original data. You can see we only have common shares for our share capital. So all we're going to do in that case is put the only share capital we have, which are common shares, at the amount listed in the trial balance, which is $809,000. Now you'll notice we have to calculate retained earnings. So I've got a double star next to that. Why is that? Well, because you can see in the trial balance that we have a lot of income statement accounts here that are still open, meaning that we haven't closed them out yet. We got a gain on the sale of land, admin expenses, interest expense. If you scroll up here, you got a cost of sales, sales revenue. So we can see that we still have some work to do in terms of calculating net income. So all I did here in order to update retained earnings is I thought, let me just calculate my income. So I took all my credit balance accounts and income, which would have been all my revenue-based ones, and subtracted all my debit-based ones or expenses to come up with net income. If I add that net income to the opening balance of retained earnings, I would normally deduct dividends that were declared, but in this question, we'd notice in the trial balance we didn't have any dividends declared. But we do notice a strange kind of item, correction of a prior year's error, and you'll notice in the trial balance that you had, it's got a debit balance. So I've got this little guy in blue here, and you notice it's in the debit column. So what would that mean? That would mean that they've decided this item, had we have known about it in previous years, would have reduced retained earnings. So what kinds of items might have reduced retained earnings in a previous year? Well, it could be that we understated expenses. If we understated expenses, that means in a previous year, that means in that year, we would have overstated net income, because our expenses were too small. And if we overstated net income, then we overstated retained earnings. So in order to correct it, because those income statement accounts from the previous year are already closed, we would make an adjustment to our opening retained earnings to reduce it. It could have also happened because maybe we made an error such that in a previous period we overstated revenue. So if our revenue was too big, again, it means that your net income was too big. And if your net income's too big, then your retained earnings was too big in that previous year. So now that we've discovered it in a subsequent year, we would make an adjustment to the opening balance of retained earnings. So, and that would mean to reduce it or debit it. So with that in mind, we'd have an ending balance of $490,000, which we've got here. So the last item we have to deal with on the statement of financial position is an account we've talked about, which is accumulated other comprehensive income. We did say in class that account is in the equity section. So how does that happen? Or how do we get the final balance in the account? Well, if you check your trial balance, they're giving you $80,000. But one thing we know that adjusts other comprehensive income in the statement of comprehensive income, which impacts the balance sheet through our AOCI account, is any unrealized gain or loss that we book on fair value through OCI investments. And you can see here we did have a fair value through OCI investment. We have that investment on our books right now at $277,000, but we know its fair value is $345,000. So now, don't forget what we said about fair value through OCI investments. Those investments are non-current investments. They are not trading investments. That means we aren't trading them on a regular basis, but we've decided to buy and hold. So if we hold them, we're going to recognize this appreciation, or in this case, we had an appreciation. We bought them at $277, and now they're sitting at $345. So we've got a gain, which is unrealized because we haven't crystallized it or cashed it in, right? So we've got this unrealized gain. Well, those unrealized gains, we said in class, what happens with them? Any of those unrealized gains on OCI investments are captured in comprehensive income through this account called other comprehensive income. And when we adjust OCI, we update AOCI. So what we said in class is just like retained earnings, where income affects retained earnings, in comprehensive income, specifically any OCI we record which are any adjustments from cost to fair value on fair value through OCI investments, that also updates AOCI. So remember, comprehensive income is equal to net income, which is where your fair value through net income investment gains or losses are, plus OCI, which is where your unrealized gains and losses on fair value through OCI investments are. Together, all these pieces of income give us comprehensive income. I'm just interested in any unrealized gains and losses that are in that OCI account because that's what's going to adjust my AOCI. So remember, OCI is to AOCI as income is to retained earnings. Adjustments in income affect retained earnings. Any adjustments in OCI affect AOCI. And one adjustment we have is that increase in the value of the shares from $277 to $345. And that's a $68,000 increase, which updates OCI as well as AOCI. So now I've got $148,000 in my AOCI. So now I have total shareholders' equity, when I add these three little fellas together, $1,447,000. If I add it to my total liabilities, I wound up with liabilities and equities of $4.222 million, which equals exactly what my total assets were. So now, the second part of the question presents us with an interesting issue. It says, if we go back, it says here, we've done our statement of financial position, but it also says, under what conditions would the statement of financial position not require classification? So now, one reason why we would have this is if the operating cycle for different segments of our business were not the same. So in other words, we could have a business that operates different types of businesses within it. So one example that we know of is Bombardier. You guys might know Bombardier for making snowmobiles, GO train cars, aerospace industry. They're involved in a lot of different and some related businesses. In their case, not all of their business segments have the same operating cycle. So if we go back to the question, it says when we're classifying a statement of financial position, meaning separating current from non-current ones, that's because we know what our operating cycle is. Our operating cycle is the same for all of our different businesses. But what if our operating cycle for some businesses is different from the others? That's when our balance sheet or statement of financial position would be unclassified. So I'm not sure if you're familiar with what an operating cycle is at this point, so let me explain. In accounting, we refer to an operating cycle as a cash-to-cash cycle. And what does that mean? From the time that a company like Bombardier takes cash and invests it in production, in making inventory and making a product, how long does it take from the time it makes that cash investment in its business from the time it collects cash from its customers to whom it sells its product? That's the cash-to-cash cycle. If that's called the operating cycle. If that operating cycle is different for different segments of the business, then it prepares an unclassified balance sheet or statement of financial position. So, the length of the operating cycle determines which assets are current and which are non-current. Okay? So, if the operating cycle determines which items are current and non, whether it's assets or liabilities, if the operating cycle is longer than a year, right, then that's going to be the length of the operating cycle. So, we've got a company like Bombardier. It has several segments. We said aerospace, transportation, those GO train cars, even financing services, right? Their operating cycles are very different. So they can't apply one cycle to all their business segments. So in that case, they would prepare a statement of financial position that's not classified. Now I've given you a link here. I've gone to that link and I've pulled up their statements. Now, I don't know if you can see this here. Maybe not. But in any case, you can see here in the assets section, notice that they don't identify which items are current. They don't do that. Let me see if I can expand it a bit here. Now you still can't see that very well. Going back. So you can notice here, you might only see the tail end of it, but these items are not separated between current and non-current. Now, if I go, and again, you can't see it here either, I don't think. So going to the statements isn't going to help. But if I go here to page 171 and the statements, right, I've got this little thing here. It says basis of presentation. And again, I don't know if you can see it here. Let me see if this helps you a bit. Okay, maybe not. But in any case, it says here that the consolidated statements, meaning it's taken all the assets, all the liabilities, and all the equities and income from all of its operating segments. And it says that they've prepared all their statements in accordance with GAAP, but it says because they carry out their operations in two distinct segments, the aerospace segment and their transportation segment, each one characterized by a specific operating cycle, meaning that they have two different ones. They don't classify the statements. So although this isn't a common thing we see, you can see in this textbook, these authors have chosen to kind of color outside the lines, as we say, and introduce you to that concept. So if you click this link, you can go to page 166 to view the statements yourself, and then look at the basis of preparation, which is one of the first notes in the notes section, and they'll explain to you that their aerospace and transportation divisions run on two different operating cycles, therefore they're not classifying their statement of financial position. So hopefully this video has been of a little bit of help in preparing a statement of financial position in detail in accordance with the example given with your text, and you've understood a little bit about why some balance sheets may not be classified.